SIPs in small cap mutual funds. Small cap funds pulled in some 35,000 crore rupees in calendar 24, nearly twice as much as what large cap funds have received, according to a report in Business Standard. Now, the phenomenon is not surprising given that small caps in general have remarkable resilience and appreciation despite all kinds of doomsday scenarios painted by the veterans and some intervention by the regulatory body, Securities and Exchange Board of India, last year. Now, all of this is obviously till now. A controversy got kicked off last week after the chief investment officer of ICICI Prudential Mutual Fund advised caution regarding systematic investment plans or SIP investments in mid-cap and small-cap stocks. And he said it's a clear time to take out lock, stock and barrel from small and mid-caps. And this is something that we at Crore also reported and discussed yesterday with G. Chokalingam. So the perhaps larger question is, how should one regard mutual fund investing in general and specific, and what should inform that approach, and what does some of the history tell us? I reached out to Dhirendra Kumar, veteran mutual fund industry tracker and founder of ValueResearchOnline.com, and I began by asking him to tell us how he was seeing this recent controversy.
No, it will not only survive, it will thrive. And let me tell you that, people are actually missing out on the context. Small cap, mid cap, and, large cap, multi cap, flexi cap, or, there are mainstream vehicles, there are diversified vehicles. The mutual funds were invented to make, investing simple. And with that in mind, earlier, most mutual fund used to be a go anywhere fund. And that is what you can actually call the tax saving funds as one. They are not restricted by their mandate to invest in small cap, mid cap, or any sector or thematic theme or anything. Likewise, this is something investors' favorite pastime is to chase recent performance. And they are, particularly susceptible simply because, small cap funds invest in smaller companies. Some people chase a defined supply. If you have to rig a stock, you really can't rig, you can't really go and rig TCS or Reliance Industry. But you can surely do something about a 300 crore capitalization company where you will have 150 crore with the promoters and another 40, 50 crore with some set of investors who will not sell. So the float in the market will be less. So that is why, when a defined amount of money goes about chasing, and we have seen that recent past performance, it becomes a self-fulfilling, a circular thing. More money pouring into small cap fund, they in turn, mutual fund managers are slaves of investors' money coming into which fund. If they get money in liquid fund, they will invest in T-bills. If they get money in small cap fund, they will invest in small caps. If they get money in index fund, they'll invest in index, nothing more, nothing less. They are expected to be fully invested. Small cap becomes more vulnerable simply because, they're more volatile. And if more investors if they start pulling out, they're so much more vulnerable. They can actually fall much more freely than the overall market. And that is what we witnessed in 2008 as well. When the market fell, the small cap funds actually fell by 70-80%, while the large cap, the Sensex, fell by about 45%.
Right. So what we are seeing today, however, is of course an unprecedented flow into the small and mid cap. I mean, last year, the figure that I have, you can correct me if this is not correct, is about 35,000 crore went into small cap funds and SIPs, and that was half of, and this was double of what went into large caps. So this obviously means that appetite is going in a certain direction from the investor's point of view, but the stock is just not there, or not enough, at least at this value or a affordable value. So there is a mismatch there. So how does this correct? Is time the only factor, or?
Time is one thing. The other is, we will have smaller companies evolving from the. Now, the problem is that, the small companies tend to be generally in a market like this. If a promoter gets excited about going public today, he is normally of the racketeering kind. He may not need the money, but simply because, he'll go public simply because he's getting the money easily. And that is what we have witnessed in all the SME IPOs. And that is where all the investigations are on. That is where, and for a while it can be sustained. The stock price can be rigged to a poor level that, some investors can be eased out or they can get an exit. But I think the only way it can happen is, once we have many of these smaller companies which were venture funded, they start going public. I'm referring to small caps which are sub 10,000 crore. We have witnessed, some very high quality small caps coming into being. You have many of these new generation companies also, and some of them are profit making too. There will be a supply, but there is Bombay Stock Exchange listed universe is so big and so old that you still have every 5-7 years, you have something like this happens. Then a lot of old companies come and weave a story and start dodging investors and actually start taking money.
So you're saying that basically, while investors should obviously continue to invest, I mean, this is sort of a last piece of advice I could ask you for, is that should you be maybe looking at the slicing differently? So earlier the slicing was, or not earlier, but let's say in the last couple of years, it may have been small cap versus mid cap versus large cap. And maybe occasionally some sectors, invest in defense companies or emerging opportunities and things like that. So if you look at where we are today in the beginning of 25, where the market's clearly in a weakened state, what do you feel investors should define their investing strategy in mutual funds, including via the SIP route?
I think for investors, they get attracted to these small caps, mid caps, thematic stories, or a sectoral play. But investors have a very simple, clear roadmap. They should do SIP, and they should do SIP in a diversified vehicle. And I'll just list the diversified vehicle for you. The tax saving fund, even if you don't have to save taxes, they are worthwhile because, it is filled with individual investors. They are not very big. And flexi cap fund, multi cap fund, the value fund, and aggressive diversified hybrid funds, aggressive ones, which is 75% into equity. A 75% equity, 25% into debt. Most investors' need can be very nicely filled with this one. And you don't need a sixth fund. This is your investment universe. And what happens is this variety of investment that we have, small cap, mid cap, and all the thematic and all the sector funds, they are basically to tempt investor because investors look at recent performance, something or the other is always at the top or at the bottom. The ones which are at the top, they are also at the bottom. They dominate the bottom at the top. So just ignore them and be on and make sure that you are investing for 5 years and more. Make sure, and then if you have done this, then you don't have to listen to Naren.
Okay. Dhirendra, thank you so much for joining me.
Thank you.